Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest from Mullen Automotive, and let me tell you, this report is a wild ride. It is a story of reverse stock splits, potential bankruptcy, and barely any car sales. Buckle up, because we're about to decode it all. Mullen Automotive just dropped its Form 10Q, and the headline, well, it's not pretty. Despite some efforts, there's a big question mark hanging over their ability to keep the lights on. The report shows they're still burning through cash and facing serious financial challenges. Let's start with the basics, the numbers. Looking at the balance sheet, as of the end of December 2024, they had a measly $2.3 million in cash. That's down from over $10 million just 3 months earlier in September. Their total assets are around $173 million, but check out the liabilities, more than $267 million. That means they owe more than they own. That is not good. Inventory, which is mostly cars and parts, did go up a bit to $41.7 million, but let's be real, inventory sitting around isn't making any money. Moving on to the income statement, the story doesn't get much brighter. They did manage to sell some vehicles, bringing in about $2.9 million in revenue, which is still very little. The actual amount from the sale of vehicles is even worse if you consider what it costs to make those cars, with a gross loss of about $3.7 million. Then we have to add operating expenses like general administration and research, which are about $36 million and $11 million respectively. So altogether, the loss from operations hits about $51 million. And it goes on. There are other expenses like the initial recognition of warrants, something that cost them about $16 million. There was also a big loss on the value of warrants and other liabilities, about $34 million. They also had to pay interest about $18 million. After all that, the total net loss before taxes is a whopping $118 million. It's clear they're spending way more than they're bringing in. What's keeping them afloat? Debt and stock sales. They got almost $9 million from issuing notes, which are basically IOUs. They also issued more stock, raising about $1 million. Now, about that going concern thing. That's accounting speak for, can this company stay in business? Mullen's own management says there's substantial doubt about their ability to continue operating for the next year. They even mention the possibility of having to file for bankruptcy within 30 days. This brings us to the many reverse stock splits. A reverse stock split is when a company reduces the number of its outstanding shares, which increases the price of each remaining share. Mullen has done this multiple times to keep its stock price above the minimum required by the Nasdaq stock market. In 2023, they did a reverse stock split in May, August, and December. Then in 2024, they did one in September and one in February. So basically, they keep shrinking the pie in hopes that each slice looks bigger to investors. In reality, it might just taste bad. These reverse stock splits also messed with the earnings per share, making it harder to compare over time. They issued even more shares of common stock. Share-based compensation is up, so people are being paid with company shares. They are saving cash and probably demotivating employees. This share dilution is a constant theme. They continue to raise money by selling more stock. Good for staying alive, but bad for shareholders. Then we get to the segments. Remember Bollinger Motors, the company Mullen bought a while back? They had a revenue of almost $3 million. Mullen Commercial had very little revenue of only $138,000, and both segments of course lost money. And that is just the numbers. They are also dealing with legal issues and regulations. There's ongoing arbitration with the GM group from that broken deal and legal costs for all the suits. All of this creates a lot of uncertainty. So what is my take on Mullen? Well, they're in a tough spot. The company has potential, but it is struggling in every respect. They've got some good things. They own manufacturing facilities, have electric vehicle designs, and even made some sales of commercial and Bollinger vehicles. However, the debt load looks unsustainable. They are constantly issuing shares and debt, diluting the existing investors. Reverse splits are never a good sign. Management wants to keep control, so new investors are basically out of luck. It is their money paying for this mess. And management acknowledges the challenges ahead. Midas, there is even a warning about a potential bankruptcy within 30 days. But what is it worth? Well, this is where it gets tricky. It is hard to make a call in this economic environment. It's tough to value a company that's not consistently profitable and that might go bankrupt. At this point, it might depend more on hype. This company's value is a long shot based solely on numbers. There's also execution and management. The best I can do is a wide range. I would expect a share price from 50 cents to $1 in the next 12 months. It may go to zero if a restructuring wipes out shareholder equity, or it may jump to $2 or $3 with a market rally and good news from the company. I would lean bearish on this one and expect a market price closer to 50 cents given that the company may go bankrupt. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, hit that like button and subscribe for more no-nonsense financial analysis.